Good afternoon, ladies and gentlemen. My name is Tricia Hawley-Davis. I work with Willis Group, which is a reinsurance and insurance brokerage. And you'll see behind me, I could not resist putting up a picture of this, because I think it captures quite perfectly the topic we're going to be discussing today, which of course is emerging risks. It's actually thanks to Trevor and clever iPhone technology that we're able to have this up there. You can all read. Please don't read the top bit about how ignorant is America. I didn't have the time or the technological capability to rub that out at the last second. If you'd like to discuss that offline later, please do see me. Our topic, of course, and it does, again, really, we have seen quite a number of significant events recently. And for lay people and even people in the insurance industry who work so closely with scientists, often it still baffles us as to what these events actually might mean for our business. And so one of the great things about today is that we're bringing together these different industry representatives, or sectors, I should say, industry with academia, and also both able to discuss the policy side and understand how that influences each of our roles. So, with that, how can science aid society in tackling emerging risks is the title of our session today. And emerging risks are, firstly, as we'll see later throughout this panel, there are a number of different perceptions of emerging risks and different definitions of emerging risks. We've decided, for the purposes of trying to clarify this in the outset, that they are developing or changing risks that pose unintended environmental, socioeconomic consequences and are often very difficult to quantify. There's the interrelationship between different hazards, natural hazards, and vulnerabilities of society and landscapes that produce new risks that perhaps we haven't previously thought of as emerging. And there are things that just aren't on our radar yet. Again, different perspectives on emerging risks. For businesses, two of the things that keep us up at night are brand reputation, supply chain disruption. Natural hazards have huge impacts on both of these elements to business, as we're seeing with TEPCO, certainly on the brand front, and also with Toyota on the supply chain front as a result of the recent event in Japan. Events. Then we have the policy side, things that keep up policymakers and regulators, but as well as businesses. Natural hazards combined with population growth and urbanization. We'll have a population of 9 billion by the middle of the century, 70% rise in urban areas. This presents risks to property, business interruption, life, health, liability, political risks. These are all emerging risks when you put these combinations together. There's a long-term systemic risk that could undermine socioeconomic stability, growth, and sustainable development. And this is why we're all here today, these different sectors of academia, industry, policy, to understand how, amid a changing risk landscape, what roles and the interconnectedness and increasing interconnectedness of natural hazards, what role do we all have to play? So the aims of this session, I won't read all of them, but you can see basically it is again to highlight the interconnectivity of the risks and the impacts that have become evident from recent events, and emphasize the urgency of communication and how we can all do a better job of communicating with each other, and to debate not just the scientific community's role, but all of our roles in understanding how to tackle these emerging risks and identify solutions to better society. Our speakers today include Stuart Lane from the University of Lausanne, Robert Muir-Wood from Risk Management Solutions, and Trevor Maynard from Lloyd's of London. I'm going to hand over to Stuart now to start us off. Thank you. Oh, excuse me, I should mention that we will be hearing from each speaker and then taking questions following their presentations. Thank you.
Good afternoon, everyone. My job is to kick off as the academic on the panel, and my objective is, in effect, to get you to think a little bit about what we mean by emerging risks and the kinds of things that we need to be doing, adjusting ourselves to, as we start to work and live with emerging risk. I want to start off by getting you to think a little bit about what we mean by emerging risks. Now, one of the papers that I insist on all my graduate students who study any kind of environmental risk actually read is by Brian Wynne in 1992, and it's a paper where he reflects upon the aftermath of the 1986 Chernobyl nuclear incident, which of course is a relatively interesting example to be looking at the moment. And Wynne makes distinctions between four kinds of risk. The first he calls the true risk. We know that certain things can happen. We can quantify them in a stochastic sense, and that's the kind of risk that's quantifiable, relatively easy to work with, even if it's a little bit more difficult to live with. There are then some risks that are known, but we can't quantify them. A kind of what I call the Donald Rumsfeld type of risk, the unknowns that could be known, we don't know what we don't know, and those things that however much we do, however much science we do, it's highly unlikely that we ever know them. And for most risk problems, you can unpack them in terms of those four kinds of risk. Now, what you can then also do is think about how is it that risk then emerges. And I think it can emerge in different ways. For instance, we might find a risk emerging because there has been some change in the probability or consequence of events, and we can start to quantify that change. We might find a process that we suddenly discover is very important in terms of the risk landscape that we can't yet quantify. So think of the current work that's been done at the moment in relation to river storm surge and trying to get a quantification of that. Still not there yet in many cases. Brian Wynne's example of radiocesium was very interesting. What happened after Chernobyl is that scientists initially thought that the radiocesium would be rapidly immobilized in the soils. What they didn't know was that finding only applied to where the radiocesium had fallen on alkali soils. Where it had fallen on acid-peaty soils, they found the radiocesium was still active some weeks after the event. They just didn't know that at the time that would happen. And so unknowns that could be known. And of course, the whole question over the security of nuclear waste is largely indeterminate because that security is a product of social and political processes that it's extremely difficult to actually forecast. So one role of science in all of this, in all of these kinds of emerging and dynamic risks, is to try to uncover this kind of emergence by quantifying the unquantifiable, by discovering unknowns, perhaps making them in turn quantifiable. And that's the theme that I want to talk about today. What is it about science, and when does science help us to effectively identify, quantify emerging risks? Well, what makes a risk emergent or perhaps submergent? Ideally, we would say that what science does is it, in some kind of horizon scanning mode, is it finds out what our risks actually are. And with that science, we can talk to the necessary policymakers, the intermediaries, and hopefully get that out to the people who actually need to know about it. But one of the things that you find when you actually look at the history of risk management is there's a very strong degree of effectively technological lock-in. We get locked into particular kinds of ways of modeling the world, of measuring the world, and what that means is that science is sometimes constrained by what it's always done. The past effectively constrains its ability to make interventions. If you like, our own technologies themselves, unfortunately, can break down this flow of knowledge from science to intermediaries to publics. And what you find in practice is what drives science into intermediaries, into policy, and into publics is often events, catastrophes. Think about what the New Orleans hurricane did in 2005 in uncovering and questioning a whole series of assumptions that had been made about emergency management. People didn't evacuate, particularly the poor black communities, because they couldn't evacuate, because unfortunately their paychecks arrived at the end of the month, and they needed money to buy public transport out of the city, and they did not have that money to evacuate. So however good the evacuation instructions were, however good the forecasting was, what New Orleans uncovered was another kind of reason for the New Orleans event. And what Rosario talks about is the idea that events are not simply destructive, but they are also creative. They are creative because they cause us to look at the world as we live in it in a different way, and therefore they have the capacity to allow us to rethink the way we might actually want to manage risk. Events remind us that risk is ever present, and that's why we need them. We need events to remind us that we're at risk. But the problem is, can we break out of that? Can we only, in effect, live with risk by experiencing it? Can we break out of our addiction to events in driving the changes we need to make risk management more effective? Well, there are two comments I want to make, and the second one is really going to be the major part of the rest of my talk. The first, and I guess this is the rationale behind things like the Willis Research Network, behind the global earthquake model, is to try and force scientists and intermediaries together to get better exchange between them, making sure that science is framed by intermediaries, make sure that scientists frame what intermediaries need to know. It's that forcing together, that fusion, that's important. But the second thing, and what I want to talk about a little bit more theoretically, is what is it that makes risk emergent? Because I want to emphasize that catastrophes are a manifestation of risk and not risk themselves. So what is it that makes us change our view of what is actually risky? And to do that, one of the best theories to help us to think about emergent risks is complexity theory. Our classical explanation of risk is that big events are rare and bigger events have equally rare causes. Classic diagram, we've seen plenty of them already today in some of the sessions looking at insurance. We have some return period down here. We have some estimate of magnitude here, and the curve goes from smaller magnitude, shorter return periods, higher magnitude, longer return periods. And that is this assumption. Big events are rare, and somehow these bigger events, which are rarer, must also have equally rare causes. The problem with that is that it overlooks a very important element of the risk story. And if you don't know it, one of the best examples of this is called the Dauntless Colocotronis. And it's written up in a very interesting book, you can see from its title, called Normal Accidents. The Dauntless Colocotronis was a ship that was traveling up the Mississippi River. It grazed the top of a submerged wreck, which had been improperly surveyed on some surveying charts. The leak was very close to the pump room as a result of the chance positioning of the tank with respect to the river, the wreck that it got caught on, and the design of the ship. A packing gland that wasn't quite tied properly allowed oil to leak into the engine room and to vaporize. When enough gas had accumulated, it exploded. The ship crew discovered the fire in the engine room, but didn't realize it was oil-fed, because why would you have oil in the engine room? And that they put water on it, and that made the oil more flammable. And then they forgot to close the fire door because they didn't know it was a fire door. And what you see in that kind of example, in that taxonomy, is a series of very small events with relatively low probabilities effectively interacting together to cause a very catastrophic event, which was the explosion of the ship. And complexity theory tells us about that. It tells us that there are 5 characteristics that elevate risk and ultimately contribute towards something becoming catastrophic. Now, I'm not going to apply it to Fukushima, but you could equally do that if you wanted to, if you want some homework to go away with. These characteristics are connections between elements of the system that allow information to be transmitted very readily. Proximity between system elements, that means that it is not important that the connections have to be long in duration. Feedbacks within systems that can make signals grow. Imperfect knowledge of connections, and note the link here to what science does. Proximity between things, imperfect knowledge of that proximity, or even hidden connections. And a system that reorganizes itself in ways that are often difficult to see, perhaps unexpected, perhaps surprising, except with the benefit of hindsight. And if you think about those kinds of 5 characteristics, systems that have those 5 characteristics are ones that are likely to be exceptionally sensitive to change, because change can get transmitted easily and it can be amplified. So if you like then, we can think of catastrophes as emerging from systems where the state of the system has evolved to being very sensitive to change. That state is not fixed. It's dynamic. We have to watch that state very carefully, a bit like what's really been happening in Japan, to make sure that the system doesn't evolve into a state that is much less sustainable than that which is needed in order for it to cope with a big forcing event. The example of that is very much the classic example rule which psychologists tell us, which is that if we don't experience risk, we forget about it, we become less resilient. Risks are emergent because the world is non-stationary, and that non-stationarity is not just in probability, it's also in consequence. We must get used to the idea that risks can emerge both because the driving forces are changing, but also the sensitivity of the system that those forces are being applied to is also changing. But of course the problem is our management is discrete. And if we're getting changing in both probability and consequence, our management systems are always going to have to be evolving to keep up with that dynamic of the changing risk. And in many ways, again, what's happened in Japan can be interpreted in that sense. That combination of not experiencing risk plus the dynamic of the state of the system has caused a very serious situation indeed. Fourthly, and this is very interesting, there may be somewhat uncomfortable limits to predictability. And that's not simply because complex systems are difficult to predict, but it's also because we tend as scientists to constrain what we allow ourselves to predict to that which we are capable of doing. One of my favorite examples of this is in UK flood risk, where quite rightly climate change has been identified as a dominant factor in changing flood risk. And we do find that when people start doing these kinds of simulations. They're 20% upscaling of flows for climate change in this catchment management plan, and the conclusion in doing that urban development and land management have very little impact on future flood risk. Well, the reason why they've been able to conclude that is because they didn't want to predict that changing urban development and land management. Our assessment does not include the impact of any additional building or infrastructure being placed in the floodplain in the future. It is assumed that this will be prevented by appropriate development control. We strip our problem down to that which we can predict. We think we can predict climate change, but perhaps another debate. Now, of course, We can interrogate that. I mean, this is the kind of thing you can do. You can look at a flood in 1947. You can look at what government said, that the flood had come to occupy the natural washing of the river. We mustn't do it again. The crux of the matter is we're going to tell everybody not to develop in floodplains. 1947. There's the floodplain, undeveloped largely in 1938. There it is in 1956. The event didn't make very much difference in that situation. But the point here is really that even if flood probability is stationary and flood consequence is changing, we may not end up predicting everything that is dynamic in the system because some things are extremely difficult to model. And at the same time, our definition of what is risk might actually change. In this case, in 1947, it was the risk of flooding to fields that was of concern because of its effect on food supply. Now, we want to flood those fields because we're worried about the risk of inundation of property. So it's not just that the risk might change, it's not just that the consequence might change, but our very definition of what constitutes risk itself can change and cause risk to be identified in different ways. How can I make sense of this for you? Well, this is a very interesting diagram from some work by a social scientist called Andy Sterling. And what Andy Sterling has done here is try to think about the ways in which we know that there are things that are problematic in the world, things that are uncertain, things that are ambiguous. And what Andrew Sterling argues is that the act of risk management is about removing those problematic things by making them unproblematic. And that we make them unproblematic by introducing assumptions, assumptions that allow us then to quantify risk. What events do, and what, if you like, make us see risk, make risk emerge, is in effect uncover those assumptions. So that's why events are so important. But there's another dimension that we have to remember. If we actually look at risk itself, one of the implications of this kind of analysis is that the risks that we predict are ultimately not reflections of the real world. And what we end up going through is what the philosopher Jean Baudrillard calls a procession of the simulacra, in that because our risk management is based upon very serious assumptions, our risk management will only work if we can make the world look like our risk models. Not, as we might imagine, our models look like the world. To make our models work, we have to simplify them. Therefore, we can only ever make sense of the world in the future if what the assumptions we put in our model are then reproduced throughout the world around us. We have to make the world look like our models. Give you an example of that. I'm being a bit tongue-in-cheek now here. I do flooding. What would a world made to look like a flood catastrophe model look like? What would I have to do to the world to make it look like a catastrophe model? I'd have to put levees around villages and cities to stop flooding directly from hill slopes, in some cases. I'd have to remove all the underground drainage, including sewerage, and find alternative means of waste disposal. Then my model would start to look, the world would start to look like my model. I'd need to design my homes so that above a critical depth of a few centimetres, as the waters rose higher, progressively more items would be damaged. Those are the kinds of assumptions we make in our model. If we want our model to reflect the world, we've got to make the world look like our model. Now, that is why events matter. Events matter because they shape risk. They make it more or less emergent. They cause us to look at it more carefully. But events come with dangers, and I want to give you 3 kinds of dangers for you to reflect upon as you go away. First is the danger of perception. Risk is time integrated, ever present but time integrated. Catastrophes are time discrete. There is a risk that catastrophes, when they happen, distort our perception of risk, when actually all we are seeing is an extreme in the distribution. In other words, 2 questions follow. When we see some kind of distortion, some potential catastrophe, we have to ask ourselves, are our models correctly representing the distribution of which the event is a part? The event makes us look at those distributions and to think them through, and there are all sorts of questions then about series lengths, data lengths, and so on. And the political question is, are we happy with the shape of that distribution, or is management needed to change that risk? We have to think about rationality. We might think that faced with an emerging risk, our challenge is to reduce it, but we also need to remember the lessons from risk heuristics, that resilience follows from the experience of catastrophe, so we must be careful about interventions that change the distributions of extremes. I'm not saying don't do them, but we just need to think very carefully about what we're losing as well as what we're gaining from those kinds of interventions. And thirdly, this whole question of prioritization. Because when we have a catastrophe of a particular kind, we tend to focus our intellectual and financial resources into that catastrophe, rather than thinking about all the other catastrophes that are out there waiting behind us to jump up upon us when our focus is in the opposite direction. Thank you.
Robert Muirwood from Risk Management Solutions is our next speaker.
We have a catastrophe. Okay, well, after that wise and philosophical introduction of this interesting existential and conceptual subject, I'm going to talk about the modeling challenges of emerging risks. And I thought I'd start just echoing what Stuart has been saying, that a lot of catastrophes are lurking there. They have the potential to happen, but they don't happen. And it's often a failure of the imagination that people are not focused on the fact that they could happen. And this is simply an example from 1891 in the state of Texas, where the local forecast officials said the opinion held by some who are unacquainted with the actual conditions of things that Galveston will at some time be seriously damaged by some such disturbance is simply an absurd delusion. And then 10 years later, the whole city was wiped out by a storm surge, and several thousand people were killed. So we really have to guard against this failure of the imagination in not recognizing that actually the ghosts of future catastrophes are already out there. Their potential exists, the potential for earthquakes which are going to destroy cities of the world. I mean, they are out there already. We really have to ensure they don't surprise us when they happen, that we have been thinking about them and trying to prevent some of their consequences. So the large majority of catastrophes are foreseeable and often foreseen. There is often someone who puts their hand up after the event and says, well, I did propose this. I mean, what is interesting are catastrophes which were not foreseen, like the fact that the tectonic community did not foresee the Indian Ocean earthquake of 2004. It's kind of shocking in a way about the state of science that it was not properly foreseen. So many events when they happen, which still surprise us, they should be foreseeable, they should have been foreseen. Volcanic ash clouds clearly have been seen before, mega tsunamis, major oil releases, nuclear releases, pandemics, insurgencies, civil war. There are some classes of catastrophe which are relatively new, in which I think you could say, the 9/11 megaterrorism was. There were a couple of sort of hints. There wasn't really an example of that, and some potential cyber attacks really are in a new domain. However, there's still what I want to focus on is this question about how do we try and model these events? How do we model the potential consequences of them, recognizing that modeling is challenging, but actually modeling can do something really useful in that it can attempt to give us a perspective on the severity, frequency, and the consequence of extreme events. So I want to talk through from a cat modeler's point of view. This is how we see the world. We see the world as something which you try and set out to model, and you try and this is the basic structure of a model. A cat modeler's risk engine looks a bit like this. You try and create a large population of possible events. We call that stochastic simulation. You look at the structure of each of them in terms of what we often call footprints, if it's a spatial structure. We look at what is in the path of the event, and we call that exposure. Now, that could be property exposure. It could be people exposure. We then look at the vulnerability of that exposure to suffering a damage as a result of the impact of the hazard, and we then turn that into loss. And in general, when we turn it into loss, we're thinking about monetary loss, but it could be loss of life, it could be loss of the environment, loss of habitat. It doesn't need to be money, but money is a convenient way of lumping all sorts of consequences together in a single parameter, and that is very simplifying in actually how one proceeds. It's clearly not the only parameter, but it's a simplifying parameter. Now, this basic structure works because it is like the grammar of sentences. If you think of the spatial parameters are like nouns, the stochastic simulation is like the adjectives, the vulnerability is the verb, the vulnerability turns the hazard into consequences, it turns the hazard into impacts and loss, and the loss is, if you like, the object of the sentence itself. So it has a really fundamental core structure to it, which is why when you're in a modeling perspective, you just view the world and think, how would I model that? How do I model this problem, that problem? And the same applies very much to thinking about emerging risks. Now, as we try and turn the world into these little boxes of sort of, this is stochastic, this is the hazard, this is the vulnerability, we have to recognize that actually the world is more complicated than this, and some of the complications, especially around catastrophes, are the way you get reverberations in the system, you get feedback around the consequences, that as events start becoming bigger, their impact goes beyond simply measuring the impact of damage itself. If you have a lot of damage, for example, it puts up the price of making repairs because there's a shortage of people to make the repairs, and the prices will go up. If you have a really big impact, it starts actually dominating the local economy. It can start dominating the political agenda. If an event starts dominating the political agenda, then in fact, once politicians get involved, they may actually change the whole rules of how you allocate costs, for example. And I'll show you a good example of that. So we have to recognize that big problems often have consequences, have these feedbacks within them which actually significantly amplify their impacts. And that is something which often surprises us when it happens, but we have to try and see if we can capture some part of that process when we build a model. So I want to focus just on one event and sort of think it through, because it's an event which we sort of thought through. How would you model this event? Now, this event I want to think through, which was, if you like, you could call it an emerging risk, a surprise risk, was what happened at the Macondo well last year. The BP was the field operator, and actually the consequences of this event was clearly far more dramatic than anything BP themselves had ever contemplated. I mean, I know from previous discussions with them, and they had a sort of scenario as to what was their worst case loss, which was the loss of a major platform, the most expensive platform. But they hadn't considered the possibility they could lose 20 or 30 or 40 billion dollars. And if you like, that was a failure of imagination on their side, that actually they hadn't pinned up what we would call an exceedance probability curve for loss into the operator's office of everybody who was actually at the front end of making decisions about drilling. Because clearly if they'd seen the magnitude of the potential loss out there, they would have been very likely to have taken different set of actions. So I want to think through how should they at the time, how should we now think about this risk and evaluate it and come up with the appropriate perspective to think about it. How do we model this risk? So this is what happened. I mean, there was a blowout of a very deep water well. There was a blowout. The blowout preventer failed, and the thing went out of control. The platform caught fire. 11 workers were killed, and then oil started surging out into the sea. So one consequence of this, if we try to work out, well, what was the impact of this? Well, one measure of it is to look at the share price of all the companies involved. There were, in fact, 3 companies that had ownership in the field, Mitsui, Anadarko, and BP. The Halliburton did the well cementing, Transocean owned the platform, and Cameron built the preventer of the blowout on the seafloor. And you can see these companies lost about $100 billion of value within about a month of the event. So this is sort of, if you're trying to, this may have been invisible but in terms of global markets, this was a huge deal, the consequences of this. So first of all, was this a surprise? And the answer is no. There'd been an event very, very similar to this in 1979, but it was in the Mexican sector of the Gulf, a well called Ixtoc-1 blowout. It wasn't deep, it was shallow, but it actually released 3 billion barrels of crude oil. It went on for about 6 months until they could re-drill it. And the main difference was that because the company that drilled the well was called Pemex, which was actually owned entirely by the Mexican government claimed sovereign immunity from the costs, or from the liability of the damage caused by the oil. And so in the US, there was no one for anybody to sue. And so as a result, the actual losses stayed very low. Now, if you just moved this event over the border, it would have been dramatically different at the time because the legal environment would have been different. But in fact, there was a lot of experience about how to clear this up. There was a lot of experience that, in fact, it sort of sorted it eventually after 2 or 3 years. It was hard to find much trace of this, that actually there's a lot of microbial activity in the Gulf which munches oil, and so on. So there was a lot which was known, but it had been forgotten. It has been sort of assumed this event no longer happened. So, okay, how do we build the emerging risk modeler's risk engine for oil spills? How should we build a model of this phenomenon? Well, first of all, we need to understand what is the frequency of blowouts. What are all those factors that determine whether a blowout can happen? And what are all the factors that determine whether the blowout fails to be prevented? And there's quite a lot of data on this, in fact, which you could use to come up with a model of the frequency of blowouts. You can look at, we know that the blowout will go on as long as the oil continues to discharge, as the pressure is there, and as long as it takes the well control process to actually try and block that well from flowing. So we can sort of estimate, there's a lot of experience of well control impact we could use for putting in our model. Now, based on how much is flowing out of the well and how long it takes, we can then try and model what is the spatial extent of all that oil release in the sea. How far does it get? Does it travel onto beaches and so on? So there's also quite a lot we know about that process. We know even more about it after Macondo last year. Then we can look at the vulnerability, which is actually in the exposure. What is exposed along the coastlines? What is the fisheries? What is the tourist industry? What are the high-value homes? Who is going to put in a claim as a result of oil on their beaches or oil in their fish? And actually, that tells us the vulnerability from which we could pass into losses. So this is a problem which is eminently modelable. There'll be uncertainties at every stage of it, but this is sort of, as I say, it's one of those things you look at and you think this can be modeled in this kind of way. So for example, deepwater drilling risk, there is in fact no evidence that drilling in deep water is more likely to have a blowout than drilling in shallow water. In fact, there's quite good statistics, sort of 0.2% for historical blowouts in wells below 1,000 feet of water and 0.26 for all depth. So there's not really a statistically significant difference in the probability. The critical issue about drilling a deep well is it's incredibly difficult to stop the oil flowing out of it if it happens. So the issue is, in terms of, we got some statistics on this, the issue is this, and we know that in most cases the well blowout is caused by failures of the cementing. But it's this problem that no one had thought through how you manage the situation in deep water, how you can't have divers operating down there, how you need robot vehicles and so on. No one had actually thought through what you need to do. And it was that which prolonged the oil flow in this case. And it was the prolonged oil flow which actually dramatically raised the cost. So, okay, the second issue we want to know is what determines the extent of an oil slick? Again, I'm not going to tell you sort of exactly how one would do this, but clearly we know a lot now about what is the pattern of ocean currents close to the surface in a given region. We know these vary through time, so you might want to, there's a lot of data on this going back in time, so you might want to start the clock at different dates and see what would be the consequences if we had the Macondo oil flow starting on at 1 month intervals for the last 10 years, because we know it would flow to different places according to when you started the clock. It's obviously critical where this well is located. We know that the slick at the surface can be moved by the wind, so we need to look at a coupled model of wind distributions through time. We might use reanalysis data for that and so on. And we then be interested to see what is the potential for it actually landing on beaches, and so on. I mean, there's a lot of data we could throw into our model now to assess actually where the oil goes, how fast it gets eaten up, how fast it degrades, how much stays as an emulsion at some depth in the ocean. I mean, again, there's uncertainty, but we could actually put quite a lot of data into this. And we then come into this question about the damage and loss, which is really the most critical element of this, is actually how does the oil turning up on a beach actually, or how does it turning up in the ecosystem in some way, how does that turn into loss? And we'd have to understand that this is very much determined by the particular liability climate of the country in which this happens. In the US, people are very smart and good at actually recognizing what are the consequences of lost tourism revenues, lost fisheries income, and so on. And actually, we now, from what has happened in looking at how much loss has turned up on each point of the coast relative to how much oil actually turned up on people's beaches, we could actually come up with some pretty good cost functions as to how the duration and the amount of oil actually turned into losses in some way. So this is our vulnerability functions. This is the key relationship that turns the hazard into losses. So I feel, again, we have a reasonably good picture of this now. And out of all this, we should be able to come up with an exceedance probability curve. Exceedance probability curve simply shows the probability you're going to exceed a given amount of loss. So you could devise a system now, and we've sort of thought about doing this, and we haven't actually done it yet, but one could, whereby every single oil well, before it is drilled, has an exceedance probability curve developed for it, showing what is the probability that you're going to be subject to a certain amount of loss as a result of an oil release there, and then how much would that EP curve be changed by various actions you could take, like having a second drilling rig on site, or actually having some improved system of blowout prevention on the seafloor. I mean, there's a lot of components of this where you can argue it's worth spending the money because you can reduce the tail of this exceedance probability curve, and that in itself would start guiding some more sensible behavior. I mean, clearly, everybody has learned this can be a really extreme impact, and in particular, we want to know what is the average annualized loss. If we look at the integral under this EP curve, it will tell us what is the cost per year. I mean, if you imagine what is the cost for every well that BP has ever drilled of the impact of Macondo, and how they now think if only they had sort of spent $2 or $3 million more on this well, and they could have prevented that massive loss. You can see that if you are thinking in this way, if you're thinking of the whole exceedance probability curve, you may be able to take action in advance of this risk re-emerging as it has done in this way. So this is just sort of working out. I mean, there were big insurance payouts for this event, but they didn't get anywhere close to actually what BP has ended up itself covering. And just on a final thought, I mean, it's already been mentioned by Stuart Lane that this question about new things are emerging all the time. There's incredible similarities between Fukushima, Daiichi and Macondo in terms of what happened. There was, I mean, just to run through, there was complacency around the level of risk. There was absence of a plan or off-site equipment for handling the situation where you both lost off-site power in Fukushima and you lost your local generating capacity. There was a failure to escalate the gravity of the response fast enough in both of them. For a few days, people had sort of sat kind of in a bit of a haze while they kind of contemplated what to do. Well, they should have taken action immediately In Japan, absolutely, there were a lot of things they could have done on day one, which they didn't do. There were far-field implications of contamination. There are livelihood issues, there's evacuations issues, marine transport, degradation, absorption into the food chain. There's a lot of stuff in Japan which is yet to come in terms of consequences, which is going to have enormous economic consequences. The fact that in both cases it's become the #1 political issue in their respective countries, and that then drives up all sorts of losses and implications, that in both cases there were strict terms of liability. I think for BP, I think the strict terms of liability for oil pollution was something like $75 million. So you might have thought beforehand the limit of their liability from oil spill was $75 million. But in fact, that was totally politically unacceptable, and they've exceeded it by a factor of 50 or something as to what was written down in advance. And that is something which was also predictable and should have been anticipated. It was a near ruinous cost to the operator for BP. I mean, it's lost 1/3 of its value now. It is going to be clearly ruinous to the operator TEPCO. I mean, TEPCO is not going to survive what's happened in Japan. And so these kind of classes of accidents which can ruin really enormous corporations are clearly something which actually should have been modeled, should have been anticipated in a much more detail in advance. And I'll just sort of leave you on the reflection. And I think I mean, this I've obviously focused on just one risk which happened to emerge. I think that as the human imagination contemplates risk, then modeling it is a really useful, important thing to do as a practical process of looking to see, are there really extreme outcomes there? I mean, what is the probability of the really extreme outcomes? There's going to be uncertainty in this process, but it's a really useful exercise to go through to turn this into monetary impacts. Thank you.
Our next speaker is Trevor Maynard from Lloyd's of London, who's really going to give us the end-user perspective, bringing together everything that Stuart and Robert have talked about.
Great, thank you very much. It's a pleasure to speak to you all today. I work at Lloyd's of London in the exposure management team, and we are thinking a lot about hurricanes, earthquakes, and all sorts of weather hazards, but we're also thinking about other emerging risks that might be affecting the Lloyd's market. So I wanted to talk to you today about our process, explain a little bit about how Lloyd's works, and then talk about the interface between academia, policymakers, and the insurance industry and the public, and how there's a sort of partnership approach here to managing risk. It was interesting just thinking about Robert's talk there and the use of EP curves to quantify risk-taking behaviour. There's an interesting twist there. If you monetize things, you don't necessarily think about the utility effects. So I think you can go one step further and not just think about the cost in financial terms, but in terms of sort of human happiness and through the utility curve. And that might be an interesting thing to leave you with. But just to talk about Lloyd's as a market, it is 85 competing companies, all offering insurance, and the brokers bring the insurance ideas from their clients into the market, and they'll speak typically to a lead underwriter who's an expert in that particular form of risk, and they will come up with a price and they'll accept a certain percentage of the risk. Not normally 100% of the risk, because one of the things that insurance tries to do is to pool risk, and Lloyd's does this in the following way. Not 100% will be accepted by the first underwriter, and then the broker will take it around the market, and slowly but surely different underwriters will take different percentages until 100% of the risk is placed. Often they're pricing quite extreme, unexpected events, political risk, for example, which is very difficult to price, terrorism, and also things like hurricanes and earthquakes, where the information arises and we keep learning new things about those hazards. So occasionally syndicates go bust, where the premium that they charged wasn't enough. In fact, it's not just the premium, they also have to all hold what is called capital, which is money in addition to the premium. The premium is a sort of average level of loss, the expected value, if you like, plus some margins. So you'd expect that not to be enough money quite frequently, actually. Then they hold this capital, which is extra in case the premium is not enough. But occasionally, even all their capital is gone. And in which case, there's a thing called the central fund at Lloyd's, which is a mutualised fund of assets which will pay the claim in the event that the syndicate goes bust. And that's one of the reasons why Lloyd's has been sort of going for 300 years. It's this interesting sort of mutualised competition that we do. I work at the Corporation of Lloyd's, which is the centre, and we don't actually write the insurance risk, but we help the market, we facilitate the market. But the other thing we do is look after the central assets to make sure that no one syndicate is posing more risk to those central assets than another. And that's why the team I run is thinking about emerging risks to sort of make sure that we're not, going to walk into a large loss in the future. So why do emerging risks matter to Lloyd's? Well, for many, many years, Lloyd's was happily making pretty decent profits for its names. It had been running for, as I said, 300 years. And then starting in the mid-80s, there was a string of very large losses coming from all sort of angles. We had some natural catastrophes. We had, for example, in '92, there was Hurricane Andrew. We had some man-made events, Piper Alpha. But we also had some interesting legal and sort of liability events, pollution events. So, for example, the biggest of that is asbestos, which was the accumulation of risk over decades that had gone largely ignored and unnoticed. People were aware about it actually from the 30s, but everyone thought that the legal system would be the reason why the claims never materialised. And then certain legal judgments came along to change our view of what constitutes risk, and to basically say that you didn't have to prove anymore that somebody's mesothelioma or asbestosis was actually contracted working for this particular company or that particular company. All you had to do was demonstrate that they had asbestos and that you had worked there for a period, and then it was deemed that they had contributed to this risk, whether or not that was provable, and then they had to pay. And of course, the insurance industry ended up paying up about 150 billion US dollars, which is a lot of money generally, but particularly because it was paid, there were no reserves held for that, because it was an unexpected risk. It was a truly emerging risk. Interestingly, a third of that went on legal fees. Then things like 9/11, that's an example where the unthinkable happens, and what occurs in those situations, I'm going to talk about this a little bit later as well, is that you get everything happening at once. You get the property loss, the aviation loss, there was fine art, of course it was a human tragedy which led to life assurance claims, personal accident claims, liability claims, and then you get lots of legal disputes about was it one or two events, etc. So another example of emerging risks and why they matter is because when things are really bad, they tend to affect everything simultaneously. And then there's Katrina, Rita and Wilma, the 2005 hurricane season, which I think we ended up paying as an industry sort of $80 to $90 billion for those three storms. So clearly we care a lot about emerging risks and understanding the insurance that we're giving and the hazards that we're covering. And this is where scientists are so critical in helping us understand these hazards. So how do losses come through to us? I mean, the key thing to get across is it's not just about the property damage, although property damage is large. Property damage, things like flooding events leading to having to rebuild houses or throw away all your contents, etc. We get marine and aviation losses, and the cargo losses we can expect to be fairly large in the Japan earthquake scenario. Personal accident, liability, as I've talked about, where you get judges making unexpected decisions. We provide things called like directors and officers cover, where if a company's share price has fallen, the directors get indemnified if they get sued. And also political risk. We do terrorism cover and war on land and all sorts of covers like that. So emerging risks can come through in all manner of ways. I've mentioned legal risks. There's also behavioural risks. One of the things that we've been looking at with great interest at the moment is both the way that underwriters think about risk and the behaviours that drive them, and the cognitive biases that there are in all of our minds in terms of sort of these representation of risks, and we heard a little bit about that earlier. And also things like societal tipping points, where what was acceptable to society before is suddenly deemed not to be acceptable anymore, and that's where you get these legal decisions that catch you out. So it means, I think, that if you're properly modelling emerging risks, you're not just thinking about the physical side, the hazards, but you're thinking about social science and bringing in all those other aspects. How are people psychologically affected by events? What's that going to do to economic losses, etc.? So at Lloyds, we have our own definition of emerging risks. I think everyone has their own pet definition. Ours is, as you can probably expect, very focused on the insurance problem, which is an issue that's perceived to be potentially significant. So we're obviously not ruling out that it might turn out not to be significant. A good example of that is electromagnetic fields, which at the moment seem to be not a health risk, but you keep getting different research into these things, and sometimes they appear to be causing, cancers, etc., and then other people say no, and so we're watching that one carefully. So potentially significant, not fully understood, and not allowed for in terms and conditions, reserving or capital setting. So there's various aspects of our business that might be affected. And my role, as I see it, is to ensure that the Lloyds market is aware of these potentially significant emerging risks. I guess that's a kind of, I don't want to be fired when it turns out that one comes along and we hadn't thought of it, but as long as we've made them aware of it, then I think we've done our job at the centre. And our particular process, we have a quarterly special interest group of experts in the Lloyds market that get together and discuss sort of horizon scanning. We produce a number of outputs, which if anyone is interested is available from our website, and they range from things like pandemics, digital risks, space weather we had recently, globalization, water security, climate change, nanotechnology, so a vast range of topics. We set up our emerging risk team sort of in about 2007 formally, and just about that time, although afterwards I'm pleased to say, so at least it looks like we're proactive, the Financial Services Authority, which is the regulator in the UK, and also the rating agencies like Standard & Poor's, Fitch, Best, etc., all started having a much stronger focus on emerging risks. It seems that everyone sort of simultaneously woke up to the fact that it's not just about what you are modelling, it's what you're not modelling that's important here. And what do we do with our research? Well, we don't, obviously we publish it and we try and make underwriters aware of it so that they can think about it in pricing terms and conditions, but we also take it and try and sort of lobby with it and try and stop things becoming a risk before they've started. So, for example, I gave evidence to the House of Lords Select Committee on nanotechnology and food, where we were talking about the insurance implications of nanotechnology. Another thing that we've done is to set up a body called the Lighthill Risk Network, which is very much complementary to the Willis Research Network. Lighthill is, at its heart, its intention is to increase the flow of information from the academic community into the insurance community, but also to increase the flow of the ideas and problems that we face into academia, so that you all can know what the sort of things that drive us and worry us and perhaps offer solutions. And the Lighthill Risk Network actually acts as the secretariat in a consortium for something called the Knowledge Transfer Network for Financial Services, which the Technology Strategy Board in the UK pays for. So at the same time as us setting up this Lighthill Risk Network, and Willis at a very similar time, the government were very much waking up to knowledge transfer and trying to formalise it. So hopefully that those routes, if you have something to tell us, then please do. So I think, just to come on to the key challenges now, I think our key challenge is to articulate what our key questions are. It's all very well, it's all very interesting to know how many storms, for example, in the Atlantic Basin will be generated in a year, and we're starting to see some very interesting methods for forecasting that, including numerical models from the Met Office, etc., and that's all very useful. But of course, really, what we care about is landfalling storms. And particularly whether they hit population centres. So, I mean, I guess that's an obvious one, but just by being very clear that it'd be really great if we could get a landfalling storm forecast rather than just a number of storms forecast. That would be fantastic. We're generally interested in impacts on population centres or commercial centres and agriculture. But we are also interested in places around the world where there isn't currently strong insurance penetration. So the developing world, for example, micro-insurance is on the increase here, and there are billions of people that don't have insurance cover that I think would benefit from it in the future. And another thing to be aware of is that there is, I mean, not that it's particularly exciting to stand here and talk about regulation, but there is the new Solvency II European directive for insurance solvency is very much strengthening the requirement to build internal models, to do modelling, to be able to back up all your assumptions with proper scientifically based logic, etc. So Solvency II is an open door, I think, for academic input. And the key challenges that I think the insurance industry would like help on are things like how can we communicate uncertainty without weakening the belief of our boards that our models are still useful, because this is a critical question. If you've got a deterministic model, the answer's 10, the board says, thank you very much, that's great, and we'll take whatever action we need to make it 9. Whereas if you say, well, it could be 2, it could be 20, then they look at you and as if to say, well, go away and try harder, when actually it might be that that's the best you can do and they need to understand that. So communication of uncertainty, quantification of uncertainty, propagating it through different models so that we can see the true uncertainty in modelling. Being very honest and open about what is and what isn't modelled. And we see this regularly when we have actual events. The catastrophe modelling firms, which I have a great deal of time for, come out with estimates, but their estimates inevitably are always caveated with, oh, and we left this out, and we haven't modelled this, and that's not in there. And that's fair enough, at least they're telling us that. But it's important for senior directors in companies to understand what isn't in there as much as what is. Another thing I'd say is that uncertainty is often a reason to act and not to delay, actually. It's often used as a reason to delay, when in fact it can really be a reason to act. Understanding dependency. And as I said earlier, 9/11 was a good example where when it's big everywhere. Katrina Rita Wilma is another example. And the Walham Power Station example there, which was in the 2007 UK floods, it nearly got flooded. It was about a couple of inches away from being flooded. Had it done so, it turned out that it was a critical node for UK infrastructure, and about 500,000 people would have had to have been evacuated, which would have been unprecedented and not since the war. So that's an example of something, a real tipping point there that was just avoided, and we need to learn from those and understand these dependencies and these critical infrastructure. Open access modelling, and I'm not entirely sure I spelt that correctly, but then I did do a maths degree and not English, so I think that's acceptable. At the moment, I've got a great deal of time for catastrophe modelling firms, but there is a sort of a difficulty people have in trying to capture the uncertainty and understand it. A lot of people are locked into using a small number of models. I think it'd be fantastic working with the academic community if we could have open access modelling that would still enable the proprietary companies to offer paid-for services, but in a modular way, and you could sort of plug and play and choose what you want to run with what. And this would require data exchange standards, etc. And I know the climate modelers community have managed this very well globally already, so I think we've got something to learn there. So I think that insurance is a global public good. I'm not sure everyone in the audience probably gets up in the morning and sort of gleefully goes and buys their motor policy or their household insurance. And that's why I've got this point that it's sold and not bought. People don't usually get very excited about insurance, but it does actually serve a fantastic function globally. I was amazed to find out recently that the global insurance and reinsurance industry actually ends up paying about 60% of all US large natural catastrophe claims, because they buy reinsurance and then we globalise and mutualise the risk by pooling it. So it really oils the wheels of the economy. But we can't do this together, and I think the final point I want to make is about partnerships. Sorry, we can't do it on our own. We do need to work together. So we've been working together as an industry in terms of things like climate change, which is obviously one of the most major emerging risks we face. We've set up something called ClimateWise, which is a sort of collaboration between 40 or so global insurance players. The Geneva Association are working together, United Nations Environment Programme, finance initiatives. So that's an example of the insurance industry itself working together in partnership. but then we need to talk more to our customers about a sort of sharing of risk between one another. We can take a certain amount of risk on, but we can't necessarily take it all on, and that's where people mitigating risk by adapting their properties to avoid the risk in the first place is a key thing we need to get across. And we need to work with policymakers, because a lot of people ask us, well, why don't you, in the event of, say, a large flood, why don't you just rebuild all the houses to a higher spec so that they're resistant to flooding in the future? You'll gain, everyone thinks that we'll gain from that. And the reason is, one, the premiums we charge didn't include that as a cost. And we have a careful balancing act each year between how much premium we've raised and how much we pay out. And in a given year, we typically pay out really quite a lot of what we get in, 90%, 80%, that sort of number. Sometimes more than 100, unfortunately. So where policymakers can help, I think, is where they can sort of mandate certain actions and then we can administer them. And I think that's a really important point, is through building codes, we can build sustainability into the process, but we can't really do it on our own. Another thing we can do is risk-based pricing, where we charge the premium that actually relates to the level of risk. There's a number of places around the world, many places, where there's enormous cross-subsidies at the moment, and that's very much, I think, hiding the true level of risk from people, and it's leading to uneconomic decisions on occasions. So we really do want to work together with academia, with policymakers, with our customers and amongst ourselves to manage these emerging risks, because the critical point here is that the information is small, so together we must be stronger. So to summarise, emerging risks really matter to the insurance industry. Our challenge is to articulate the key academic questions that we need help on, and they would include things like understanding uncertainty and communicating it, understanding dependency and methods of modelling that, open access modelling, and then finally, through partnerships, I think insurance can continue to be the global public good that I believe it is. Thank you.
Thank you very much for that. We're going to open it up to questions. I have to say that just my observation before we do that is I was a bit concerned that we might go off in a direction and start debating what qualifies as an emerging risk. But I actually heard a lot more of a consensus than I did a divergence, particularly around this underlying driver of emerging risk having to be a lot to do with our lack of imagination and our forgetfulness, if you will, of past events. And I'm going to throw this out there, and I don't know how Bruce will react to this, but and propose that perhaps next year we might have an additional panelist on this stage representing the social or psychological sciences to help us understand the behavioral part of what keeps us kind of repeating our same mistakes, if you will. I certainly have a number of questions for our panelists, but I want to open it up to the floor and give you an opportunity. So we have a roving microphone. If you could just raise your hand and please state your name and affiliation, your specific area of expertise, if you will, and also direct your question to a specific or any one of our, or all of our panelists. So, questions? Raise hands. Who's there? Yes, there. Bruce.
Hi, Bruce Mallam at King's College London. I'm the outgoing president for the Natural Hazards Division. One of the questions I've been wondering about is often the emerging risks that we're discussing are very low probability events. And what kind of probability should we be sort of looking at and trying to insure ourselves against? I mean, are we looking at 100-year, 1,000-year, 10,000-year events from the point of the reinsurers, from the point of the academics, and also from the policymakers?
Yeah, please, Trevor.
I mean, that's a very interesting question. It's kind of whose return period are we interested in here? So from the insurance industry's point of view and the regulator's point of view, they expect us to be able to withstand, as a minimum, a 1 in 200 annual return period. So in that sense, each company has to hold enough money to be able to survive a 1 in 200 annual aggregate loss. What should different individuals buy to? What probabilities should they think about when insuring themselves is a very interesting question, and I think that's where it comes into the utility argument as well, is that you can't, it's not just about money, it's about, you know, your own view of money and what would make you unhappy or happy. So I don't think you could answer that question in a generic sense. It's quite a personal thing. The only thing I think that we've tried to say today is that risk is a lot more likely than people think, and we have a tendency to forget. So that would be a key message, is for the policyholders, is to be open-minded and perhaps to think things can happen that they currently think can't.
Well, the nuclear industry has been working to various definitions of I think, of life loss as a result of a nuclear accident, and actually often looking at a 10 to the minus 4 annual probability of exceedance for things like earthquake shaking. And clearly, I think, you know, what has happened at Fukushima, people are going to have to look again at actually how they've been doing this. So I mean, you can have certainly a target level of probability, and I think the target levels used by engineers for critical facilities tend to go to longer return periods than you typically find in the insurance industry, which is interested in sort of hundreds up to 1,000 year or so, is really about the extreme limit. So so these critical consequence issues, people are looking at lower probability events. You know, nuclear waste disposal, I think they're looking down to 10 to the minus 7, and yeah, I mean, it really does stretch the imagination when you think you've really captured the behavior of processes, and you really feel you understand what is happening at that levels of probability. I mean, it's kind of scary, I think. I feel that the levels the insurance industry use are sort of within a range, you know, a few lifetimes of a span of sort of history is giving you some perspective on 100, 200 year return period losses. I think that's a much more comfortable space to be in than where people have been providing these lower probability thresholds for critical facilities.
All right, okay. I'm going to answer that with 2 comments. I mean, I think the first thing is your question is an extremely important one. My experience is that this whole question of what the level of probability is that we wish to live with is one of the causes of controversy in risk management. I can give you an example of a community in the north of England that's been flooded. This is about 40 properties, flooded 4 times in 10 years by events with return periods that in statistically average sense about 1 in 10 years. They cannot get flood protection because they have to be judged against a standard of the 1 in 100 year flood, and the cost of protection to the 1 in 100 year flood is extremely high. So this matters, and it matters that society's got to take that on board. It's not something I think that scientists should really be judging upon. I think the second thing I would say there is a body of literature in, again, the social psychology literature that has looked at this question of what level of risk we're prepared to live with. And of course, that's where you get all of the slightly odd and difficult to understand findings, the link, for instance, between the risk that we're prepared to live with and the perceived benefit. And we tend to, where there's a perceived benefit, we tend to be more prepared to live with a higher level of risk and the consequences that come with that. But there is a literature out there that can steer us on that. But I think it's actually one that's quite difficult for a scientist to actually answer. I think it's a societal debate, ultimately, what we decide to do.
Thank you. Yes, gentleman there, and then gentleman in the front. We have a... And then, oh, okay. 1, 2, 3, great. No dearth of questions, we like that.
Okay, can you hear me? Yeah. Nick Watkins, British Antarctic Survey. I was very interested to hear Robert, I think it was, use the words failure of imagination at least twice. Many years ago, when he wrote a book called Profiles of the Future, Arthur C. Clarke distinguished between failures of nerve and failures of imagination. I think failures of imagination is when you can't imagine something at all. Failures of nerve are when it's staring you in the face, but you can't bring yourself to acknowledge it. And I'm wondering if you think that's still a useful distinction, and if it is a useful distinction, is there anything we can do to help, steady our nerves contemplating these huge risks? That's for the panel, really.
Well, I mean, I personally try and focus on the failures of imagination, and are constantly trying to find examples of where we have had these failures of imagination. One which I'm very focused on at present as a result of what's happened in Fukushima, I think, but also because it has it's absolutely consistent with what happened in Hurricane Katrina. In Hurricane Katrina, they evacuated people from the pumping stations in New Orleans because they weren't designed to withstand a Category 4 hurricane. And they hadn't thought it through that actually a big storm surge is likely to come in the middle of a big hurricane. So for safety purposes, they evacuated the workers. In fact, the buildings weren't damaged. But having evacuated them, they couldn't get back again because the city had been flooded. And that was a sort of failure of kind of this connection. So you can see all the individual pieces may have appeared rational, but you put them together as a sequence of events and they appear totally irrational, and that's really a failure of the imagination. In Fukushima, they clearly had sort of planned for various things like a tsunami height and a backup generations, but they hadn't planned for the fact that they would lose off-site power and they'd lose their generators and the workers wouldn't be able to go to and from work anymore, and would be stuck there, and they'd be plunged into darkness. They'd had a failure of imagination at connecting all these things in an extreme event had the potential to happen at the same time in sequence. And it's that which I think is sort of somebody, some institution needs to go through the world and just hammer out these kind of failures of imagination in systems issues, because they will happen again. I mean, they very nearly happened in a nuclear power plant in France on the Gironde estuary in 1999, where in a windstorm called Martin, there was a big storm surge. The storm surge was higher than they thought it could be. It flooded the whole lower floor of the nuclear power plant at Blavet. It shorted all the secondary cooling system. The plant lost its primary electricity supply because the windstorm blew down the pylons, and the workers couldn't get to and from the plant anymore. I mean, they were lucky. They went through a level 2 emergency. They pulled it through. That could easily have become Fukushima, in fact, in France in 1999. And that was, people don't know about it. They don't talk about it. And these near misses are incredibly important to evaluate these connected linkages of phenomena.
Thank you. We have 2 questions over here, and then we'll go back to that side of the room. Do we only have one microphone, one person going around? Okay. There was a gentleman there. That was you. And then in the front there. Yes, please.
Massimo Cocco, INGV Rome. I would like to know which portion of the globe is served by insurance or risk management services. So which nations, which portion of the world, of the countries in the world? Do you have an estimate of how many countries you are already served by insurance and the insurance companies?
Which countries provide? Was your question which countries provide risk management solutions? Yeah.
Or if you prefer, how many countries are already planned activities for reinsurance and insurance services?
I can't, so I will answer it by giving you examples rather than an actual number, because I don't know the answer. But certainly there is a variety of approaches to dealing with natural catastrophic risk. In the UK, for example, there is the insurance industry cover flood, and that's actually quite unusual, whereas in the US there's the National Flood Insurance Program. Interestingly, you often find that in these sort of political solutions where it's a government-backed scheme, they don't have the requirement to charge risk-based rates, and they end up owing money, which is what the NFIP currently does. So around the world, you'll see a whole range of different schemes, people with earthquake pools, sometimes insurance solutions, sometimes not. Sometimes the insurance industry acts as a sort of administrator for the scheme and then passes it on to the government. Our view generally is that most natural hazards are insurable and reinsurable, and that it is actually probably better to let the insurance industry and reinsurance industry do that pooling activity and globalise the risk rather than any one government hold on to it. But not everyone agrees with that, of course. But I don't know the exact number, I'm afraid. I can't answer that. I'd like to just quickly comment on the failure of nerve point, because that is a really good sort of concept here. Failure of imagination, yes. How can you help with it? Well, I think the answer is building models and scenarios. One of the things we did when we looked into the behavioural risk report that we wrote last year was this idea of scenario bias, which is people can't seem to sort of believe in a risk unless they can think through a scenario of how it could actually apply and how it could really occur. And that's often the way people win arguments, oh, that could never occur, because you can't come up with a plausible scenario for it. And equally, it's a way that people sometimes make you overreact to risks because they can pose this lovely sort of visual scenario for you. So I think the answer of the failure of the nerve one is, do please continue building models and show that every step from that initial risk that occurs to, possibly many in sequence that leads to the final outcome that you're trying to warn against is entirely plausible. Here are the probabilities that we see, and in so doing, I think the onus then falls on the naysayer to say why they think it can't occur. That would be my way of answering that. How you get around that problem.
May want to, just before we go to the next question, bring in Stuart here, because I think that there are a couple of elements. One of the things that you said earlier about this creative destruction, and unless people actually feel the impacts, but to Trevor's point, if you can envisage feeling the impacts, that would motivate you or mobilize you to change and to act.
Yes, I think this notion of failure of the imagination is very interesting. I think one of the things we need to recognise, particularly when we come at risk from our own particular sectors, our own particular, whether it's an industrial position or a particular discipline within academia, is of course we bring the notion that in our professional livelihoods, the risk that we study actually matters. If you were to take all of the risks that all of the academics around the world study, that they all think matters, and you were to all add them all up, and you were to worry about them all, I think you'd become severely neurotic. And that in many ways the failure of imagination is a failure to imagine that life will always have risk in it. In other words, what's really serious is a failure to accept that risk, and a failure to look at the extent to which, I think we heard the word a little bit earlier, that our management of that risk is somehow biased from what it should be. The distribution's not being represented properly, because I don't think we can make the risk go away. And if any of you want to read more about that, read Ulrich Beck's work on effectively risk society, because he very eloquently explains why that's the case.
Gentleman in the front, and then there's a lady in the back. Thank you.
I'd like to just...
Sorry, can you just state your name and affiliation, please?
My name is Bob Bishop. I'm an independent scientist. When I look at the title of this program, I'm thinking more of emerging science rather than emerging risk. And specifically, if I think back at the theory of tectonic plates, this was a scientific theory that was very much delayed before it was accepted, because you may know it was proposed by Alfred Wegener, who was a meteorologist, and it wasn't accepted by the geologists, two different scientific specializations. As a result, today, even though that theory is accepted, we have a large amount of the building stock around the world, including many of the earlier nuclear plants that have been modeled and simulated without the potential impact of tectonic plate-induced, subduction-induced levels of earthquake and tsunami. And I believe in the case of Fukushima, which is the General Electric Model 1 plant, that is exactly the case there, and it may be true for many other nuclear reactors around the world of the earlier generation. So my question is, from an insurance viewpoint, are you demanding that many of the earlier nuclear plants are remodeled and resimulated with more up-to-date tectonic plate dynamics?
Thank you.
One of the things about working at Lloyd's is that we cover the entire world and just about every risk you can think of, which makes me not an expert in just about everything. So I don't know the answer to what the actual underwriters of nuclear risk are asking. I wouldn't be surprised if they're rethinking their models as a result of this latest event. I mean, as it happens, the government in Japan, because it's a natural catastrophe, they actually take the risk away from the insurance industry in this particular case, but that's not like that around the world. So it could, if it had been somewhere else, it may well have been an insurance issue. And I wouldn't be surprised if they're rethinking models. But also your point about different disciplines arguing and there's a delay in uptake. One of the things we did in one of our reports was this, looking at things like confidence intervals, and we'll only accept something when it's past some sort of arbitrary confidence interval. We're very interested to hear about things that are below that threshold, but maybe at 80% confidence or something. Because I mean, I don't know where 95% came from as a threshold, but it seems pretty arbitrary to me.
I think if I may, I think your question actually throws up something that harks back to what Robert point he made in his presentation. So you might want to chime in here, which is if we're going to, and again along this theme of are we learning from past catastrophes, that what happened with BP, if it had done an exceedance probability curve, would we have had the same result? And are regulators now mandating that this happens for future drilling before they license these drills? I suppose this is very much in line with what you're suggesting about nuclear power plants.
Well, in answer to your specific issue, I mean, I think I'll give you a couple of perspectives on it. I mean, one is that actually, I think once a country has created certain critical infrastructure, it's very resistant to any outside agency telling it how it's to do its hazard assessment. And one interesting slow motion collision, which I'm interested to watch, is actually how the global earthquake model is going to attempt to revisit seismic hazard in certain countries which think that they have this problem solved, such as New Zealand, such as Japan, such as the US. I think it's a really interesting question as to whether the hazard establishment in those countries is going to put up a fight to prevent a global agency, or if the global agency is going to have the courage and the scientific imagination to demand that it should have an overall perspective on hazard in those territories. I think it's going to be very interesting, and I suspect the countries are going to win. Because I think they got too much invested in the decisions already taken, as with nuclear power plants built a certain height above sea level in anticipation that you don't get tsunamis higher than that. So I think that's interesting question. I mean, the other answer to your question is that it's not just plate tectonics. I mean, it's interesting that actually you're right that actually these facilities were built just before plate tectonic theory about subduction zones, and yeah, that is interesting. I mean, the other thing is that the idea where magnitude 9 earthquakes could occur was developed in a theory which went beyond plate tectonics and had the idea that there were two parameters: the speed of plate motion and the age of the ocean crust together told you where you could have magnitude 9 earthquakes. And that theory was actually refuted by the Indian Ocean earthquake of 2004. But no one actually acknowledged that it had been refuted, and that in fact magnitude 9 earthquakes potentially have the there's no reason why they couldn't occur anywhere along subduction zones. And actually that has never, I think the scientific community in that discipline had a failure of nerve in actually really stepping up and acknowledging they got it wrong, and actually going forward they themselves were going to lead the charge to reassess earthquake hazard on subduction zones around the world.
Okay, thank you. We've got a lady there, a gentleman over there, and then a gentleman in the center. Thank you.
Yeah, thank you. My name is Kirsten von Elberfeld from Klagenfurt University in Austria. I have a mixture of comment and question to the first two speakers, to Robert and Stuart. I was very delighted that you, Stuart, said kind of that complexity theory might be a good background theory for risk management, risk research. But a key characteristic of complex systems is that they are very sensitive to initial conditions. So the question now is, if a system is very sensitive to initial conditions and you try to model this, I would hypothesize that this is only possible in retrospective, as you showed us in your talk for the oil spill, etc. You can only know afterwards. So how do you close this gap between this theory and modeling?
I think the fact that we still, despite the very best efforts at modeling, we still find situations in which our models haven't worked is probably symptomatic of the effect that you're describing. Now, I expressed your point about initial conditions in a slightly different way, in that I described initial conditions as effectively the state of the system. And the argument, therefore, if you think about it in terms of complexity theory, is that it's the state of the system that matters, that determines the sensitivity or otherwise of the response. Now, I guess that what I would argue then is that it's probably the nature of our predictions that need to change a little bit. We need to be looking much more for indicators that tell us that the system is evolving towards an unstable state than we do actually trying to provide detailed deterministic predictions of what's going to happen over particular time periods. And there's a really interesting analogy here, and if you want to read more of this, I would read the work of Paul Ormerod, who looks at financial risk, in effect. And he very eloquently has explained, as a number of people were doing, that for people that looked during the middle part of the last decade, 2004, 2005, at some of the indicators of what was going on in the global financial economy, they had actually started to say that the system was evolving to a highly sensitive and highly unstable state. But it was a very different kind of prediction that they were producing based on a very different kind of modelling that is much truer to complexity theory. So I think you can actually do something with complexity theory. I don't think you have to despair, but it's very different to the kind of deterministic approaches that we're perhaps a little bit used to, even situations where we apply stochastics to a deterministic model. So I think you can actually do something with it.
Thank you. I'm just aware that we have 4 minutes remaining, so if we just keep the questions and the responses brief. Thank you. Sir, please.
My name is John McCluskey. I'm an earthquake scientist from the University of Ulster in Ireland. I'm one of a growing number of earthquake scientists who, having given up on prediction, is beginning to believe that there is real gains to be had in identifying places which in the near future may be more likely to have large earthquakes than other places. One of the things that makes us forecast averse is the fact that risk-based insurance pricing might end up that if we get these forecasts wrong in some places, we can end up doing more harm than good. Is there any way around this, or is it a fundamental problem of that driving force within the insurance industry?
It's interesting, the concept of more harm than good as well. I mean, how would you characterize doing more harm than good?
If as the result of a forecast which has to be a probabilistic one, you end up extracting the ability of a particular community or area to get insurance cover, to be able to afford insurance cover, which would drive industry away from the areas, etc. So that whereas in the absence of risk-based pricing, the worst we can do is just get the thing wrong and it doesn't do any harm. Whereas if it really materially damages the ability of these communities to get insurance, you can end up having a real economic impact on their...
I know Stuart has some thoughts on that, if you want to have a go and then pass over.
Absolutely delighted to listen to Stuart.
Thank you. There's a classic book you may know about, which is called The Coming Quake, which looks at exactly this question for Los Angeles. What would you do? What would you see happen in a city if you said in 5 times there will be an earthquake of this magnitude in this part of the city? What would happen to the city? And of course, it's largely it's a social scientifically informed exercise as to how a community would organise itself. And the overarching conclusion is that there would be some potentially serious consequences for the whole organisation of that society. Now, the way I've thought about this is as a broader issue, because there is a very interesting trend that's gone on in relation to insurance at the moment, which of course is to develop more spatially explicit forms of forecasting. So whether we like it or not, there has been a move away from the idea that we can, if you like, globalize our exposure to risk by saying that those who perhaps are a little bit more exposed ought to pay a little bit more money. Now, for that, I make a bit of a distinction between the kind of globalization and mutualization that I think Trevor was talking about, where I think actually we can get much more effective use of the insurance/reinsurance market if we can provide slightly more sophisticated, spatially explicit, time-dependent forecasting, as opposed to the level at which we use insurance at the community and household level, where too much incursion of that kind of forecasting in that part of the market could have some fairly dire social consequences.
Thank you. Did you want to add? No. Okay, we have our final question here. Yes.
Agustin Garcia from Atmospheric Science Center, Mexico. There are fast effects from the risk and slow effects. For example, the exposure to air toxics that induce cancer. There is an emergency risk for this type of risks, the slow one.
Can you repeat?
Yes, the question is, there is a consideration of for example, air toxic exposure for long term to air toxics that induce cancer, for example. There is a consideration in the emergency risk.
Yes. Is your question, is the health impacts an emerging risk?
What can be considered as an emerging risk?
I would say most certainly, but
yes, that would definitely be an emerging risk for us, and particularly if the toxicity could arise through negligence of a company, for example, because then they would be liable and we would end up paying through general liability policies or D&O policies. So yeah, absolutely. That's why nanotechnology is on our list. That's why synthetic biology is on our list, because whilst they might be wonder technologies in many respects, they also have many unknowns, and asbestos has taught us that we can pay a lot when things lead to harm.
There's a special, Trevor mentioned in his remarks earlier, a group of insurers that belong to something called ClimateWise, which aim is to try to understand the impacts of climate change on our risk, and pandemics is one of the working groups within that as well. So, yes. Okay. Any final remarks? We're finishing just 1 minute late, I believe. So, ladies and gentlemen, please join me in thanking our distinguished panel and yourselves for being here and your interaction and interest. So, thank you.